Today is Monday, November 28th. This class is being recorded. First and foremost, here's the sign-in sheet. Don't forget to sign this. Today what we're going to do is we're going to talk about some end-of-semester logistics. We're then going to go over homework 11, and then after that we'll do an in-class practice on some multiples analysis in advance of your extra credit assignment on Wednesday and your Dentsu final presentations. Okay? So back to kind of end of semester. I don't know if you're going to consider this good news or bad news, but there are 2 live classes left this semester. This one and a week from Wednesday. Okay, that's it. So we're pretty much coming to the end. There's no more content that I'm giving you. We're just kind of going through the answers and talking through what we've already done. Okay, so basically today, as I said, we're going to cover. On Wednesday, I'm going to give you the second of the 2 extra credits, which is going to be called homework 12. It's optional, but it's going to be worth up to 3 points towards your semester grade. Okay, some teams kind of struggled last week with the presentations, so I decided to make the final extra credit worth 3 points, not 2 points. This is it for extra credit. There will be no more extra credit opportunities. So if you want extra credit, other than showing up last week for the presentations, this is it. Okay. Basically, I'm going to give you an assignment that's going to be due Wednesday night. Okay, it's not due the following Monday. Okay, so that's why there's not going to be a live lecture on Wednesday. I'm going to give you Bloomberg Lab Day to get the data to do the extra credit assignment. It's going to be on 3 companies, and basically you have to get the data and do the multiple assignment, write a 500-word paper, turn it in by Wednesday night. Okay, if you want to do the extra credit. I haven't posted it yet. We'll be posting it later today. Okay, so that is your final extra credit available this semester. All right, so you have Wednesday to work on that. All right. Monday, I am giving you the day off in the lab so that you can work on your Dentsu projects, your final group projects, which we'll come back to in just a minute. The other thing that's due on Monday is down here, there's something called the assignment replacement. Okay, so you have until Monday to turn that in. Okay, what the assignment replacement will do is it will replace any of the individual homework assignments with a full grade as if you have done it. Okay, so let's say, for example, you just didn't do homework 11. Okay, you lost the 3 points, you got a 0. You do the assignment replacement, you get 3 points as if you did homework 11, and more importantly, it'll be counted as if you turned it on time, so it won't work against your opting out of the final exam. Okay, so you don't choose which assignment you replace. Next week, the TAs will apply the assignment replacement policy against your assignments. And what they're going to do is they're going to take either an assignment you missed or the assignment with the most points and the lowest score, and then that's the one that's going to get replaced. Okay, so they'll replace that for you next week. Okay. Now, the reason why I'm making the extra credit due on Wednesday, homework 12, and the assignment replacements due Monday is because all the grading's got to be done by early next week for the entire semester, all the assignments. I'm going to give the TAs to catch up time on this, including your homework 12. I also want to give you some time to get some feedback on homework 12 as well as homework 11 so that you can use that to help you with your Dentsu project, which is due on Wednesday. So let's talk about Wednesday. Wednesday, December 7th, I believe that is, will be our final day of class. You'll make your Dentsu presentations. Okay, 10 minutes per team. We'll talk about that in just a minute. The other thing that will end on Wednesday is the second half of the Bloomberg Trading Challenge. Okay, so that scoring will be done based on your performance at the end of day Wednesday. In fact, a quick check-in for this section. This is section 101. So you're going to be graded on portfolio value. Remember, don't be above $300,000 in cash, and also make sure that, you have 10 longs. Okay, so this team needs 2 more trades. This team needs 4 more trades by next Wednesday. You have to have 10 long, right, in the second half of the semester, or you won't count. So that's next Wednesday. Again, don't liquidate your portfolio because you don't want to go above 300,000 in cash. I'll just take the screenshots and apply the grades based on where you end up next Wednesday. Okay, so that'll be the Bloomberg Trading Challenge. And on Wednesday, you'll do your group projects for Dentsu and get those presentations. Next Thursday, which I think is like December 8th, basically, that's the day that all of the opt-out criteria and all the grades will be applied. And again, it'll be applied by the TAs. So you don't have to apply the criteria. They'll do it for you. If you're able to opt out Friday morning, December 9th, you'll go into Elms, you'll see an announcement to check, and under your final exam score, it will say 10 points. Okay, we'll put in 10 points. And then you don't have to take the final exam. If you haven't opt out, you'll have a 0 by your final exam score, and then you'll have to take the final exam on Monday, December 12th. Okay, the final exam will be a multiple choice exam, 10 to 12 questions, auto scored by Elms. Okay. The reason I'm going to auto score it is because I want to get the grades in. So basically, when you complete the exam, if you take it on Monday, later that day, you'll see your grade, right? And then that will be put in as points. The final exam, multiple choice, will cover theory, covering the entire semester, okay? Anything in the book, anything in the lecture notes, fair game for the final exam. It's open book, all right? But nonetheless, it will cover the theory. So the midterm exam was like solving a problem. The final exam is the theory of the class. Which of the following would improve your ROIC? A decrease in current liabilities, an increase in long-term liabilities, a decrease in blah, blah, blah. And I'll give you multiple choices, and one will always be none of the above, and then you'll basically answer the questions. Okay, so there'll be 10 to 12 of those for those of you taking the exam. You'll take that during class time. So again, you don't physically have to be here, kind of like the midterm, but during class time on Monday, December 12th. Okay? And then basically the grades, you'll know your grade at the end of the day, December 12th. Okay? So your grades this semester, remember, are based on total points accumulated across all assignments. After the second extra credit this week, there's going to be 105 potential points that you can earn this semester. The 2 points from last week's attendance and the 3 points from the homework 12 on Wednesday, okay, plus the other assignments, okay? Your grade in this class is not a percentage of those points, it's the total points applied to a standard system. So for example, out of 105 points, you need 93 points to get an A. Out of 105 points, you need 90 points to get an A minus. Out of 105 points, you need 87 points to get a B plus. If you're a finance or accounting major, you can't have less than 70 points or you're not going to be able to pass the class. Okay? So that's where you need to be across all the assignments. And you'll know what your grade is based on that. Elms will mislead you because Elms was never designed to have more than 100 points available in a semester. So Elms does a percentage of total. So if you look at Elms, it'll say 90 divided by 105, it'll look like a B in Elms, right? But your grade won't be a B, it'll be an A minus, because I look at the points. I don't look at the percentages, okay? So you just have 5 extra points to apply to get the grade across all assignments. And that's the other idea, which is the grade in any individual assignment doesn't matter. It's how you accumulate points across all the assignments for the semester. Questions about any of that so far? Yes, sir.
Do you know around roughly what date all the assignments will be graded?
Early next week, because as I said, Thursday, they have to do the opt-out criteria. So the TAs are catching up on everything, plus grading this week's homework 12. That's the other reason why I'm trying to give them a little bit more time by getting it done on Wednesday this week. So give them time to also get it graded for next week. So, but yes, it has to be in next week. Any other questions? Okay, a couple of other miscellaneous things. There's going to be a final peer review on the final group project. It'll be due on Thursday of next week, just because I need to know that for final exam, opt-out criteria, and any grade adjustments. Okay, so it's a quick turnaround on a peer review if you need to do a peer review for the 4th group case, right? And Next semester, it looks like I'm having about another 170, 175 students across 4 sections. So I'll be having 4 undergraduate TAs. If anybody is interested in the undergraduate TA position, you can feel free to apply. There'll be a link. Basically, pays $15 an hour. You work 10 hours a week. So basically, you can do the math. Works out to be about $2,500 for the semester. Basically, you're doing grading, you're doing office hours, got to help students. 2 criteria: you still have to be a student. So if you graduate, you can't be a TA, and you need an A- or better in the class. Right? But if you're interested, apply on the link, and we're happy to talk to you about that. So that's coming up as well. And then I guess finally, in terms of these grades and assignments, once again, for the opt-out criteria, as I said, you will find out whether you're opting out of the final exam next Friday morning, week from Friday. Okay, so then you'll know. Until then, we won't know. Okay, but then we'll apply the attendance criteria. They'll apply the grading criteria on the minimum grades. The replacement exam, replacement paper, if you chose to do it, would have been applied, and then they'll let you know. So you won't find out if you're opting out officially until next Friday. Okay, and then the following Monday, you'll actually take the exam. All right. Well, if there are no other questions about end of semester logistics, let's talk about homework 11. So Nikes, Adidas, and Lululemon. Okay. So again, oh, sorry, one other thing. Dentsu, group project. So for Dentsu, next Wednesday, right, you're going to do an analysis, and I think I said 4 teams last week. It's actually going to be on 6 teams. 6 companies plus Dentsu. Okay? And here's where I forgot. So when you go to Dentsu and you do your multiple analysis, and you go to Bix under RV, the default is the whole firm, but just as we did in the EIC analysis, Dentsu's got 3 business segments. They have an ad business group of competitors, they have an IT group of competitors, and they have an application software group of competitors, right? So what you're going to do is you're going to do Dentsu, same Dentsu, against 2 peers from each of those segments. So you're going to go to this list for advertising companies, and you're going to pick 2 of those companies to do the multiple analysis on against Dentsu. Then you're going to go to the drop down, you're going to go to IT, you're going to pick 2 of these companies against Dentsu to do the analysis on. And then you're going to go to application software, and you're going to pick 2 companies off of this list against Dentsu to do your analysis on. Okay? So you have to do basically Dentsu, 2 companies, 3 segments in 10 minutes. Okay? So again, strong recommendation is that I wouldn't just put the screen up there and riff in real time, because you probably won't get through everything in 10 minutes. Like, make sure your presentation's pretty tight. You might even consider some note cards or something to prompt you along. Make sure you cover all of that data, because if you run out of time, as you know in the past, it can hurt your grade. Right? So that's what the final presentation is going to be on. Now, for each of these 3 segments, these 2 companies, you can choose. I'm going to let you choose who you think is appropriate. So if you take a company that basically doesn't have a PE, I wouldn't choose that company, because it's going to be hard to do a multiple analysis when they don't have a price to earnings multiple, right? Because they're probably losing money. And then wacky things have to be done. Okay, so I would probably choose easier to explain companies. As a matter of fact, you might even want to sort to the bigger ones, like take an Adobe. I would expect many of you would probably choose Adobe as one of Dentsu's peers in the software business. Okay? They're much easier to explain company when it comes to their multiples. Right? As a big company, they're more stable, right? As opposed to a startup, which is going to be harder to explain. Right? Not saying you can't do it, but as I said, if you're doing your final presentations, like I said, I prefer to hit a layup. I'm not Steph Curry. Right? It's hard to take those half-court 3-point shots. He's really good at it. You can try to do that, but for your final grade, I don't know if you really want to go out there in the Steph Curry range. But it's up to you how you want to choose your shots. All right, questions about Dentsu and what's going to be expected? You got to put all that data into the PowerPoint, by the way. Can't use Excel. So all the screenshots from Excel need to be in there. All your screenshots, the EOs and the wax screenshots need to be in your PowerPoint as you walk through. All the segment data's got to be in there as well. Yes, sir.
Does it have to be like 6 different companies, or do you use the same company?
Can't. They're different. You got to use 6 different companies because they're going to be different by segment. Because Adobe's not going to show up in the list for IT services.
Okay.
So you'd have to pick 2 different ones in IT services. Yes, although the one company that will be constant is Dentsu. Same Dentsu, just 6 different peers. Yes,
The region that we're using for, like, to pick the companies, global develop.
that's up to you.
Okay.
I didn't say about the region. I just said you had to choose one of the segments. But so you can go global, like we went with Adidas in the last one, and you can do a global company. It doesn't hurt. I just would take a bigger global company, or you could do domestic. But for example, when I go to here, for advertising business, there's the global list, and then here is their Japanese companies. The problem is, if you go to Japanese companies, there's not a lot of big advertising agencies in Japan. Like, they're the dominant player on a global stage. So you could choose one of these companies, but I think it doesn't make as much sense given what we did with the EIC. So I'd probably consider that more of a global business. Okay. Any other questions? All right, let's talk homework 11 then. So Nike, Lulu, and Adidas. Okay, starting out with a price to earnings multiple. I did my data over the weekend, so your numbers may vary slightly depending on the day that you did it. But essentially, this would have been approximately the data we needed, right? And for some reason, ROE got changed for Nike. Just do a quick goal seek on this one. Might have been play around the last class. There we go. All right. So basically what you'll see is that Nike and Lulu, starting there, Lulu is trading at a premium in their PE. Their multiple's 31.5 versus Nike about 28, right? So why? Well, Nike has a pretty big spread, right? And what I told you before is that when the return on equity or return on invested capital is above 30%, it doesn't change things all that much. So whether you choose a 45%, 50%, 60% ROE for Nike, it's not going to make that too much difference in the G, okay? Because basically at the high spreads, it's all about the G. So for example, if you made this a 60% ROE, you'll notice that that PE is not going to change all that much, okay? So the point is Nike has a very high spread. I think that's what the market is saying about Nike. And Lulu has a pretty high spread, though not as expected to be as high as Nike's. But here's the point. Why is Lulu trading at a premium in the PE? It's all about the growth. So even though Nike's spread is about 40 points and Lulu's spread is about 22 points, okay? Basically, Nike's G at 6.24% is less than Lulu's expected G of 7%. And that's why Lulu is trading at a premium to Nike, because the risks are pretty similar. The cost of equity, 9.4 and 9.6. That's not really making much of a difference. Okay, so it's all about the growth as to why Lulu's trading at a premium for PE. Right? When I think about what's going on with Adidas, in order to justify that PE, Adidas has a much higher cost of equity, 12.6%, versus Nike at 9.4%. So that's one of the reasons why they're trading at a discount to Nike, is because there's more risk at Adidas, okay, right now in Germany. So with that high level of risk, 12.6%, basically they have a much lower spread. It's about 9 points of spread, 22 minus 12.6. But here's the point. It's lower spread at a higher risk. So even though Adidas is expected to have a lot more growth at 10% versus 6%, the problem is that growth is a much lower spread and at a higher level of risk, and they're still ending up trading with a lower PE than Nike, 24 versus 28. Okay. Somewhere in there is about what you would have needed to have said in your papers and write-ups. Questions? Okay. EV to EBIT. So EV to EBIT, again, looking at Nike and Lululemon, here the WACC is different. Okay, they were much closer cost of equities. Now they're about a half a point apart. So now WACC does play a role. So Nike and Lulu have similar spreads based on 2021 operating ROICs, right? And given that the ROEs look pretty consistent over time, you could assume that today probably does look a lot like tomorrow. So I was using today's operating ROICs as reflective of tomorrow. So essentially, Nike and Lulu had pretty high spreads, okay? Both companies about 40 points of spread. But the difference, why is Nike trading at a slight premium, despite the fact that Nike has a similar spread to Lulu? Nike's WACC is 9% and Lulu's is 9.5%. So Nike has a lower cost of capital at a similar spread, and that's why they're trading at a slight premium. The other thing that's helping Nike's EV to EBIT be almost 24, while Lulu's is about 23, is Nike's paying lower taxes. Their tax rates are not the same. Nike's expected to pay taxes close to 16.5%. Lulu's expected to pay taxes close to 28%. And that tax advantage also tends to help Nike's EV to EBIT be higher. So two things are happening with Nike. Despite the lower growth, 5.97% against 6.9% at Lulu, Nike has a lower risk with a 9% WACC for a similar spread and lower tax rate, 16.5% versus 28%, to give them a 23.67 EV to EBIT versus Lulu's 22.98. For Adidas, Adidas is trading at a discount to both Nike and Lulu. And if you look at Adidas, what's going on there? Despite their high growth, similar to the PE, 7.59%, Adidas is suffering from a lower spread, 21.99 versus 10, about 10 points of spread, 10, 11 points of spread. But also, they have a much higher WACC at 10%. So even though they have growth at a high spread, a lot of growth at the high spread, it's being offset by that higher WACC at 10%, right? And that extra 1 point of WACC is why Adidas ends up trading at a discount despite their high growth in the EV to EBIT to Nike. Something in there. EV to sales. Generally, the primary driver for EV to sales is margin. Okay? That's the most important part of that, EBIT margin. Because the whole idea is that how much do I pay for the next dollar of sales? I'll pay more for sales if you make more profit, which generally leads to more cash flow, unless you're reinvesting it all. So poor productivity will offset that. So in this industry, Nike has an EV to sales of 3. Adidas has an EV to sales of 1. Why is the 1.17 a discount to Nike at 3.14 for Adidas? Because Adidas has the lowest margin in the industry at 5.8%. Okay, so Nike's margin is 13.3%. So it's pretty clear. People are paying a lot more for Nike sales because their margin is 2.5 times higher than Adidas. That's why they're trading at a premium for EV to sales. So even though Nike is a little less productive, 0.26 versus Adidas 0.20, it wasn't the dramatic difference we saw for like Costco, Walmart, and Target. Basically, the driver here is margin. Okay? For Lulu, why are they trading at 5 times EV to sales, 5.1 versus Nike? Why are they trading a premium to Nike? Because they have the highest margin going forward. Apparently, when you buy their leggings and stuff, you're paying a pretty high markup for that stuff. Okay, so essentially 22% margins at Lulu, even though they're a little bit worse productivity at 0.39 versus the 0.26 at Nike, is why people are paying $5.1 of enterprise value for every dollar at sales at Lulu versus 3.14 at Nike. That's why they're trading at a premium. So it's pretty clear that the margin explains the difference. So this should have been a pretty straightforward assignment. Data was pretty straightforward. The analytics were pretty straightforward. Anybody have any questions about homework 11? When you do your Dentsu, my recommendation, choose companies that are clean like this. I intentionally chose these 3 companies because they were fairly straightforward. Right? Because remember, what we're trying to do is we're trying to fit the academic key value driver formula and what's representative in those numbers in perpetuity to explain what we see in the real world, to match up essentially with a DCF. Okay? So we want clean. We want the formulas to kind of explain what we see in a very constructive way. We see that in this industry. Okay? The example that we're about to do in class is going to be messy. Okay? Because you don't always get clean in the real world. Right? And so usually when you say messy, it means that today doesn't look like tomorrow. Okay? And when we're trying to do perpetuities, that's a problem. Because if I'm using the numbers for today in perpetuity, and they don't look like what people are thinking the company's going to be look like long term, then it's going to be harder to actually explain the company's numbers with today's data. So this is where we will have to adjust some of the numbers to basically get more representative data. Okay? So the three companies that you're going to do the in-class work on, it's not for a grade, just for practice, are Raytheon, RTX, Lockheed Martin, LMT, and a company called TransDigm, it's TRG or TRD. TransDigm, I think, is TDG is their ticker, TDG. Okay. TransDigm is basically a parts supplier to the commercial and military aircraft industry. Okay. We know Raytheon is half commercial, half defense. We know Lockheed Martin is kind of a defense company. Okay. But the reason I'm choosing these companies is just because they're all mature and they're big companies. But two things. One, in the defense industry, these companies, particularly Lockheed Martin, have been buying back huge amounts of stock, okay? Essentially manipulating their earnings per share. And when we introduced the concept of the price to earnings multiple, I said that even though PE is kind of intuitive to understand, the problem with PE is it can be impacted by accounting distortions. And one of the accounting distortions occurs when a company buys back a lot of stock, because you're buying back at market value, you issued at book value, and you can actually end up with no equity or very little equity buying back a bunch of stock. And that means your return on equities become extreme and to some degree distorted. It's not really the returns you're making, it's just based on the no equity on the books, the returns on equities are either meaningless or they become extremely high. And so we have to come up with a return on equity that is more realistic for the company in that case. Or, like Raytheon or TransDigm, they were affected by the commercial airline business during the pandemic when basically people weren't buying a lot of planes and their performance last year kind of sucked. So today doesn't look like tomorrow for these companies. So we have to come up with something that looks like a more representative tomorrow when they get back to a more normalized business. So that would be the other thing. We'd have to come up with a return on invested capital, return on equity that they would be trading as if they went to normal, because their multiples are probably based on a return to normal as opposed to their distorted numbers from today, which are more outliers. Okay, so we have to adjust some of these ROEs or ROICs in order to do that. The final thing I want to give you as a hint as you start working on this is there should be a relationship between ROIC and ROE. Okay, and I'll just draw it here on this slide. So ROIC, simplified, is profit divided by invested capital. Return on equity is basically profit divided by equity. Okay, and I'm cheating a little because no plat's one profit, net income's the other profit, but just kind of conceptually. But here's the real point, is that ROIC times invested capital over equity conceptually gets us closer to a return on equity. meaning they're kind of related by the capital structure. Okay, as I said, there's a little nuances here because profit is no plat in one and profit is net income in the other. Okay, but assuming that there's not too much of a distortion there in interest expense, it's at least correlated. So the point is, the real driver here is that they're related by the amount of debt to equity in the firm. Okay, so if you lever up and you have more debt, then you can get a higher return on equity. All right, versus if you don't have a lot of debt, you're not going to have a higher return on equity, and there should be some relationship between return on invested capital, return on equity. So here's the point: if we get a normalized return on invested capital for a company, we can look at their debt to equity ratio, and we can kind of come up with what the return on equity should also be normalized. Or we could say, here's the return on equity, given the debt to equity ratio, we can kind of solve for what the ROIC should probably be. Okay, so just an example, let's say I was 60% debt and 40% equity. Okay, so what I would do, simplistically, is if this were 1 and this were 0.4, just take 1 and divide it by 0.4, which I'll do on a calculator here. One divided by 0.4 is the same as multiplying by 2.5. So if I had making the numbers up, 10% ROIC, that's supposed to be a 10. It's hard to draw with your mouse. I'd multiply by 2.5, and I'd be saying somewhere in the 25% range would be my return on equity. Okay, so there's a couple of different ways to play this. So if I knew my return on equity was 25% at this capital structure, I would have about a 10% ROIC. At this ROIC, at this capital structure, I would have about a 25% ROE. Okay, so that's the other thing. So if I can get one of the two that I'm pretty confident in, I can solve for what I think the other might be. So these are a couple of adjustments that we would have to make to come up with reasonable return on equities and ROICs for spreads before we solve for the growth rate. Final way that you could do this is we have been basically saying that it's easier to calculate a spread going forward, and so our process has been find the spread, solve for the G. Okay, it's not as ideal because G can have a lot of impact, but we could basically put in a G and we could use the solver to solve for an ROIC. Okay, because the other part when you plug and chug is you need realistic numbers. So for example, if you took Raytheon's data as of today and you plugged it in, you're probably going to get an extremely high G. And what we know about the company is they're a mature company growing a few percent a year. So if I have a G of 7%, that's not going to make sense for a company like Raytheon going into the future. I could buy it for a Nike or an Adidas, but I wouldn't buy that for a Raytheon as a mature defense company. So the point is, I could put in a 2 to 3% G for Raytheon and basically say, given the trading multiple, what would that ROIC be? I could back that out with the solver. So there's a couple of different ways that we can take a bite at this apple, but you're going to need to do that over the next 20 minutes. Okay? So come up with the data and the analysis for those three companies. This is not going to be graded today. You can work in pairs, 2 or 3 people, and then we're going to talk about it in 20 minutes or so, and we'll debrief this. Okay? But as a hint, your homework assignment on Wednesday will be messy like this. Okay, so what we're doing today is kind of a setup for what you're going to probably have to do on the extra credit on Wednesday. Okay, just letting everybody know. Okay, it's not going to be clean like Nike and Adidas. So 20 minutes, have at it, and then we're going to debrief.